All right, this installment of Chapter 7 covers the basics of internal controls. Your book goes on at length at this, but this is a sort of a summary of everything that's in there. Right, so internal control system consists of policies and procedures too, and these are in order of importance. Step 1, number 1, protect assets. Again, theft avoidance and prevention. That's a lot of what we've been talking about so far. Right next to it is number 2, ensure reliable accounting, which is, again, it's pretty self-explanatory. Make sure our record keeping is accurate. It's so close I could really say that this is like 1 is protect assets, and 1 lowercase a, which looks like a giant dot actually. Lowercase a is ensure reliable accounting. I mean, they're very, very, very close to each other. Number 3 is promote efficient operations. Again, cost benefit of internal controls. So to make more sense out of that, think of it this way. You can devise a system that nobody could steal from, but it would be so inefficient that nobody could work with it. In other words, going back to the previous example where in the voucher system where we had 4 people involved in that transaction with the purchase of the truck, the moving van. It's pretty safe. Now, what if I added a 5th person to kind of check up on other people? Would that make it safer? Well, there's a 5th person involved, so you could argue, yeah, of course. But how much more? Because that's what you'll observe is as I add people to the system, it's a diminishing marginal return concept. In other words, we get less and less out of it. So what if I added a 6th person, a 7th? Again, it's getting safer, but again, how much safer? Probably not a lot more. Plus, these are additional employees, so there's costs associated with that. And then, of course, what's also happening is we're making a much less efficient system. It's getting bogged down. So that's why it's a balancing act. How many people do we need to make this area safe and keep it efficient? So that's why you got to be cognizant of what you're doing there. Just don't add additional steps to make it more complicated. Add additional steps to make it safer. Now, if you want to look at a documentary series that will talk about where internal controls fail, I would recommend looking at the McMillions documentary if you have access to that was through HBO, because that was really just a giant internal control failure ultimately. And the funny thing about it was it was a guy going to the bathroom with a briefcase handcuffed to his wrist, and he knew the other half of the combination lock on the briefcase, his own plus the person he was traveling with, who, by the way, was an accountant from a firm. So their problem was what? Only 2 people were involved in transporting these game pieces. Maybe that's enough, but it actually wasn't. They probably needed a 3rd person in there, and it would have made it theft-proof. And there are other mistakes in there as well. Why didn't they change briefcases? Or change combination locks over the years? Obviously, these things were not happening. So it was a big internal control failure as it led to that. And again, adding 1 more person probably would have prevented the theft. Maybe even 2 more. Maybe they should have had 4 people instead of just 2. You could argue that as well. If you watch the documentary, you'll understand why. And then lastly, ensure compliance with laws and regulations, also self-explanatory. In other words, your system should have it so that you're not actively doing anything illegal in defiance of law. Right, so that's your basic ideas there about the structure of internal control system. Now, principles here, there are 7 of them. Again, these are not necessarily in order, they're just it's just a list of 7 things. So number 1 is establish responsibilities. In other words, 1 person per area of responsibility. So it's important your employees understand their responsibilities, and we'll talk about a way of assigning responsibilities through another one of these principles in a moment. Number 2, adequate record keeping, maintain adequate records. Again, this is pretty self-explanatory. Adequate documentation, control of transactions. That one sort of dovetails with number 2 on the previous list. Number 3, insure assets and bond employees. So in this case, insuring assets, I think everyone's up, to snuff with that. Oh yeah, okay, I get it. Taking insurance on your stuff. But this one, what is bonding an employee? That is insurance against employee theft, and we consider this a human resource control. Now, what we're doing here is we're literally taking out an insurance contract in which through a bonding agent, and the bonding agent will take this prospective employee and they will run them through criminal databases to see if they have a criminal record. And if they do, of course, they won't give you the bond then. So that's the first use of the bonding agent, is it gets rid of, eliminates any employees who are simply there to steal from the company. Now, the example I like to usually use in my lectures is, let's say you're dealing with a jeweler gemologist, and you want to hire somebody new who's cutting stones and setting stones, whatever. And keep in mind, like, the amount of gems that somebody could have in the palm of their hand could be, equal to $100,000 or more. So obviously, it's pretty easy to walk out the door at that. So this is an area where you'd want to definitely bond an employee. So let's say you're this business and you go to the bonding agent. Here's my first prospective employee. And they put that person through their criminal databases, and they say, well, guess what? This person has a record a mile long. We're not going to insure them, and I recommend not hiring them. They're just there to steal. In fact, that's a lot of what they've done, is stealing from places that they've worked. So it just saved you that headache. Next person goes through the same procedure. Everything checks down 100% fine. What's the advantage of this? So you say, okay, now we'll hire them. And it also, you let the employee know, hey, by the way, we have a bonding contract. Now, what's, out on you, we're bonding you. So what's the benefit there? They know that they're being bonded, so that means if they steal from you, they're not really stealing from you, they're stealing from the bonding agent, which is important. You're just a jeweler gemologist. You're just, you don't know anything about recovering stolen goods. Bonding agents do. That's some of what, it's like that's their business, is recovering stolen property. So if you steal from your business, you're really stealing from the bonding agent, and they will come after you, and they know how to come after you. They know the places to look to front stolen merchandise, and they might hire a bounty hunter. So they're going to send Dog the bounty hunter after you, and you're going to go to jail. So it also is a way of letting the employee know that, keeping them honest, if there was any inkling of a possibility of them thinking of stealing from you, probably going to deter that now. That's good. On the positive side, they get bonded successfully, no claims, and let's say they go into other jobs, and sometimes you see employees say this, but they have a bonding history. That means they've had several bonds taken out, and in no instance has there been any claims, which is good for them and the company, the next employer, because why? Because it's cheaper. They can go to the next bonding agent and say this person has a positive bonding history, and the cost of the bonding contract goes down. So it's good for everybody in this case. Everyone wins with the bonds. All right, number 4 is one we talked about earlier, and that is separating record keeping from custody of assets, which is covered pages 3 or 4 of my proper handout and in an earlier video. It escapes me which one it is now because I'm doing these all kind of in order. All right, so physical control we're talking about there. Again, very important. And that was one where the treasurer and the receiving department had custody of assets, and record keeping was in 2 AP clerks. So keep that separate. Now, number 4 is really a specific example of number 5 here, divide responsibility for related transactions. And again, that's the separation or segregation of duties concept. If you can keep that one straight, that covers a lot of territory. A lot of what you're trying to do here, as far as safeguarding assets, is going to be separation of duties. That's going to be your number 1 thing that you can utilize. Now, technological controls, number 6. Again, computerized systems are very valuable because why? Because they can facilitate these 4 objectives. They can help you establish responsibilities, because how somebody logs into the system is going to tell them what their area of responsibility is. Like, what accounts do they have access to? What don't they have access to? That will pretty much tell them like what their area of responsibility is by virtue of what they can and cannot access. It is also going to help you maintain adequate records. I think that would be a hope for that one. It's also a way of dividing responsibilities. In other words, those AP clerks can only address the system in a specific way. And also you can say that, oh, by the way, treasurer, you have no access to the system because we don't want you to be able to put transactions in. Oh, by the way, people in receiving, you have no access to the system. So again, that's going to help. Actually, I could have added number 4 to the list, really, now that I think about it. So it helps separate record keeping and custody and separation of duties in the broadest sense. And then our next and final principle here that I haven't discussed yet, number 7, is performing regular and independent reviews. Again, this is going back to the internal audit function, and this is independent internal verification. In other words, through technology, these internal auditors who don't report to anybody, like obviously they don't report to the CEO, CFO, or COO. They probably report to, this is a good idea, in your board of directors, you want to have one person that's an outsider. Why? So they can report, so that your internal auditors, I should say, can report to them as, this outsider. In other words, they're not part of the clique. So if there's somebody's doing something illicit, there's a person who they can turn to and say, hey, by the way, we have proof that so-and-so is doing something wrong. And then again, they're not going to inform anybody because they have no real friend. That's why I always want to have one outsider on a board. Good idea. What are your limitations here in your internal control system? Of course, number one is pretty obvious. Human errors. People make mistakes. There's only so much you can do. Again, you can have great technology, but people still can make mistakes, and you can still undermine your idea about having adequate records and reliable accounting. It can become unreliable because of errors. And then, of course, one we discussed a little bit earlier is the idea of collusion. Two or more employees are combining to defeat an internal control is always a weakness. But remember, the more people you add to a collusion, the more likely somebody's going to get honest. That's why, to me, I've always considered the Ocean's 11, 12, whatever the permutations are of those movies are absurd. There's too many people involved. Somebody's going to get honest and maybe turn other people in. And this last one, business size. Smaller businesses may not have the resources to develop fully formed internal control system. Now, what happens is a lot of times, and then I've been teaching a long time, I have asked the question, or we go over like an example of like, this is like a bad idea. One person's job would be to be the treasurer, and they're entering accounts payable, debits, credits, and maybe doing bank reconciliations. And I've had occasions where I've had students raise their hand and go, hey, that's my job. Small business, right? It can't hire a lot of people. Now, as you get larger, this is a danger. That's what I'm talking about. It becomes dangerous to have one person having all these responsibilities in a related area, that they should be separated. But sometimes, guess what happens? That one person gets overwhelmed, so they end up having to hire out somebody else. So on accident, sometimes internal controls get better just because of the necessities of the job itself. One person can't handle all that work, so I got to hire somebody else. So you just made the internal control system stronger without even trying or even understanding it, I should say, just on accident. But you should, at some point, when the numbers get large enough, be cognizant of, wait a minute, we got to hire more people, we got to start separating these areas, otherwise we're in danger, right? You're in danger of that one person with too much power can potentially say, well, so nobody's looking at what I'm doing because I'm the only person overseeing this. They can just, clean the bank accounts out and adios, they're gone. So it's a good idea to be aware of like how the size of the business is progressing, and do we reach a tipping point where we have to hire more people? All right, so next subject matter we're going to discuss, as you can see right there, is ways of reporting cash right there. What are ways you can report cash? Right, cash includes, when we say cash, we mean the following: currency, coins, checks, money orders, and bank deposits. So anything that fits into that idea right there. Now, post-dated checks, which are not net negotiable, are considered part of what? Your accounts receivable until the check date. In this case, you can pretty much ignore, oops, no, wrong thing there. I'm thinking of something else in another area. Strike that, it's fine right there. Now again, cash sales paid with a post-dated check are going to be booked as AR, and then become paid in full as of the check date. Long video gets a little loopy here. Anyways, so that's why some companies don't take post-dated checks, because they don't want to deal with the annoyance of having to do this temporary accounts receivable situation. All right, some companies might have something called cash and cash equivalents, which means everything that we included here in cash plus any short-term investments that we consider to be very liquid. In other words, they're practically cash. So in other words, the rules here is the amount is defined, maturity date is 3 months or less so that it's insensitive to interest rate fluctuations, and treasury bills, T-bills, are a classic example of this. And this concludes this video. If I go on any longer, I'm just going to probably make more goofy errors. So I'll see you in the next one.